Hello, good morning, everyone. A very warm welcome to this second quarterly webinar of 2026. Thank you very much for taking time on Sunday morning. We really appreciate it. My name is Sumit Singh, and I'm a partner at SmartWealth.ai. Along with me, we have Pankaj on the call. Pankaj is the founder and principal researcher of SmartWealth.ai. So before we start, let me quickly tell you about the structure of this session. So in the session, we are going to have a small presentation by Pankaj. In that presentation, we are going to cover some important topics like the macroeconomic situation. We'll review the markets and we'll see how our products have navigated these conditions. We are also going to talk very briefly about the SmartWealth.ai DMI framework and our DSP portfolio and how you can make best use of the resources which are available. This will be followed by a Q&A session. So while Pankaj is presenting, if you have any questions, you can always type it in the chat and we'll take it towards the end of the session. And with that, I'll hand it over to Pankaj. Pankaj, over to you.
Thanks, Sumit. Good morning, everyone. Welcome to this webinar. Thank you for taking time on a Sunday morning. So I'm just going to share my screen. If it is visible, Sumit, you can confirm.
Yes, Pankaj, it's visible.
Okay, great. So starting with disclaimer. So is important. Please read through the disclaimer. And on the bottom right, there's a QR code. If you want to follow us on LinkedIn, you can scan that. It will take you to our LinkedIn page. From time to time, we publish updates on LinkedIn about the market, about portfolio, and our point of view. And on the top right, there's an email ID. If you have any question unanswered in this webinar, please feel free to write to us and we'll be happy to answer those offline as well. So with that, let me just start. Like Sumit said, we have 4 sections. So macroeconomic review, product and market review, then deep dive into our portfolio, DSP portfolio and the framework. And we have resources followed by Q&A. To start with, let's go through the macroeconomic situation. It will set a context for, the market discussion and product discussion. So we see that, India is in a good economic spot. So last year, RBI had undertaken 3-4 successive rate cuts, and the interest rate is currently at 5.25, which is the policy rate, and it's a very low rate, good, capital availability in the economy for economic activity to happen. Despite the low interest rate regime, the consumer price inflation is at 5%, which is a good inflation number to have, which is below, the past trajectory. So overall, this is helping with real GDP growth to occur. So real GDP growth is on a good trajectory, and the forecast is 7.2, which is an excellent growth rate for India. And the GDP growth is largely driven by infrastructure activity, or very significantly contributed by the infrastructure activity. And if things continue, it's possible that, within this fiscal, RBI may undertake one more rate cut, which might make, even further capital availability for economic activity to happen. So I think in the messages from economy perspective, India is in a good spot. The second major theme is geopolitics. I think this has been persisting for a long time, but in this quarter, the conflict has significantly escalated. So what was Israel-Iran conflict has escalated beyond the region. US joined this conflict and actually led to a crisis of, crisis for oil and subsequent, broader economic ramifications. So the Strait of Hormuz, which is crucial for oil transportation, was blocked by Iran and US as well, which led to increase in the logistics cost, increase in the the insurance premium. As a consequence, the crude oil price shock was observed. So from $80-90 level, it went to $100-110 level, and it basically led to 2 things. One, the energy cost for Asia and for Europe, which depend on this sort of this passage. That energy cost drastically increased. The second is it also led to uh, accelerated depreciation in the currency of Asian economies and of Europe. So really, those are the two things. Economy is good, but geopolitics is a risk leading to uh, higher energy costs as well as greater pressure on the currency. The third theme, which is silent, not not talked about enough in the Indian context, but it's a global theme becoming more and more relevant as time progresses. It's AI. So artificial intelligence. Clearly, there is a divergence that is being seen between traditional investment theme and AI theme. So really, AI, the valuation of AI is increasing dramatically, and AI is led largely by United States in the world. So it's important to understand what is going on in the US to understand, how geopolitics, AI, etc., might shape up. And if you look at the broader context, economic context of US has very high debt, which is a multiple of their GDP. The GDP growth rate in real terms is around 2%, which is below their long-term trajectory. So there is growth pressure. The inflation in US is much higher than in the past, and despite that, the interest rate is has been not in this particular month, but over a long-term trajectory. If you compare, they are in a lower interest rate regime. So they have low growth rate, high inflation, and yet low inflation, low interest rate. It gives the impression they are following inflationary policy to pursue nominal GDP at the cost of inflation. And the second theme is that their fiscal situation, their geopolitics, and AI, these three themes are getting increasingly intertwined. So AI is extremely energy intensive, and most of this geopolitics, the geopolitical events we are seeing has an energy angle to them. So we saw Venezuela in the previous quarter. We see, US joining the Iran war in this quarter. So what happens to AI uh, and what happens to geopolitics? I think one is impacting the other, and the other is impacting the first. So it will be interesting to see how geopolitics shape up, and therefore how AI shapes up. And overall, I think the sustainability and profitability of AI as a business model will determine a lot of things. I think it will determine how geopolitics unfolds. It will also kind of impact how investors see the traditional way of investing. It's non-AI. I wouldn't say traditional, but I mean uh, all ways of investing without AI. So I think right now the mind share has been captured by AI, and that is basically how that unfolds will be interesting to see. So, to go a little bit deeper into macro situation, let's discuss two other things. One, little bit deeper into oil, and then we'll move into the monetary policy situation and the role of gold. So, starting with first, which is oil. So before US joined the conflict, the Brent crude was $70 to $80 range, and when the conflict escalated, at the peak of the conflict, the peak of the panic, the crude oil went to as high as $110. So really, they say when crude prices increase by $15, it takes away one GDP percentage growth from the world. So this is fairly escalated prices for fairly long. So it really has the ability to take the world down by 3% real GDP points. So we saw that level of panic when the markets declined, the landed oil cost for Asia went to the roof. Despite that, the real the landed cost of retail oil based products, which is petrol and diesel, did not increase. So for a long period of time, the oil marketing companies in India actually absorbed this oil price shock, the increase in the input cost, from their own margin. And as the conflict progresses, if it is prolonged, then of course some of that cost will be passed to the end customers. And we are seeing some of that has already started happening. So while the peak is over, we are still not we have not reached the pre-conflict level. It is still the slightly above the long-term trajectory, and we are in a state where the energy cost has got inflated for a large part of the world. So that is something to be really aware of. And we shared our view in Money Control, about this in May. The second very important part is the role of bullion. So, whenever whenever the world goes through a period of low trust in the monetary policy system, in the monetary order, or in the financial markets or financial system, in periods of low trust in monetary system or financial system, the bullion assets see a dramatic rise. And we've seen this two times before. Once in 1970s, when the US broke the fiat currency and gold linkage. So earlier, the number of dollars you could print was dependent on how much gold you have. So when that connection was broken, it led to loss of confidence in fiat currency or the paper money, not only for US but for most of the world. And at that time, we saw a gradual buildup of asset gold and silver prices over half a decade. And once confidence was restored, then the bullion price is correct. We saw the second instance in subprime crisis, 2008. There was a major global financial crisis, financial meltdown, and in the years that followed, both gold and silver rose. And once the trust was restored gradually, these assets corrected a bit. Now, what we are seeing in the present episode is, in my view, an aftermath of COVID. So a lot of monetary interventions were made during COVID, and those have had lasting impact. So from 2023, you could say these were, conditions were evolving from 2020 onwards. 23 onwards, it became quite evident that gold is rising, and it is rising probably at the expense of other asset classes. And when we did the last webinar in February, they were continuing to rise. So the level of activity we are seeing in this episode is not very common. It happened only twice in the last 50 years. And in the data that is unfolding in the last 2 months, it seems that the gold prices have hit a resistance. To observe that a little bit closer, we built two charts here. The top one on the left is US, the bottom one is India. And we see somewhat striking similarities, right? So gold was in momentum, but somewhere at the end of June, beginning of February, gold has hit a resistance, a ceiling. And both, India and global markets, the gold seems to have entered a consolidation phase. At least the momentum has got broken. Now, whether it restarts the bull run or not is yet to be seen, and whether it consolidates or declines is yet to be seen. But that momentum has been broken. The second inflection point is that equities were facing downward pressure for a very long period of time, and it seems that equities have found a support in April. So the downward motion stopped, and it showed some signs of reversal. Now, if you see the third inflection point, that is where things become a little bit interesting. So if you compare India and US charts, the reversal continued. Whereas if you see that reversal sort of fizzled out, it seems to have been a false start, or there are factors inhibiting that reversal to manifest. So those are the things. So takeaways are: one, it seems like the gold momentum has been broken, or it has found a resistance and it's consolidating. The second is the fairly long period of time equities were under downward pressure. It seems like there may be a reversal. We have to wait and watch. The third is, while this reversal is fairly evident and sort of pronounced in US, it seems to have not. It seems to have been a false start, or the consolidation is back to consolidation phase. So that's a quick view of gold. Why is it so important to understand what's going on in gold? So to explain that, on the left side we have a simulation. So we see, over a period of 20 years, we've analyzed gold and equity. So we have three columns: gold, equity, and a blend of that. And we are measuring these two asset classes on three parameters. So risk, return, and risk adjusted return, right? So you have annualized return, annualized volatility, the worst drawdown in 20 years, and the Sharpe ratio. Broadly, these are three, four things you can take away from this. One, equity has the highest growth rate among these combinations, definitely higher than gold, but it also has much higher volatility, leading to much higher drawdowns over a long period of time. Now, for a small infusion of gold, when you infuse gold for a small cost of, returns, so for a small decline in return, you can significantly reduce the volatility. In fact, when you combine them, the volatility of portfolio is lower than the volatility of equity, and it is lower than the volatility of gold. So the combined portfolio is much more stable than both the underlying assets themselves. And this helps in controlling risk adjusted returns significantly. In fact, when you blend them in risk adjusted return, it significantly enhances the performance over a long period of time. And that's the theory and simulation. On the right side, this shows how this gets implemented in real world. So this is a quick snapshot of our diversified stocks portfolio. And while the peak conflict has been escalating in the world, geopolitics, you would see, in both 1 month terms and 6 months terms, that blending gold helped A, reduce the volatility of portfolio, and B, it also help mitigate the drawdown that is occurring in the market. So when we dynamically bring in gold, it helps in those things. And of course, when the market become bullish, then this allocation can dynamically be reduced as well. So that's the role of gold, and that is why it is extremely important to monitor what's going on in gold relative to what is going on in equities. Now, while this helps in volatility reduction and drawdown control, this is not a risk-free approach. That is and there's a evidence of that from end of January, when gold hit a resistance, and it was largely because of change in the margin trading policy of gold, and that caused a sudden shock. Actually, we saw two things. In 2-3 sessions, the price had risen a lot, and then in 2-3 sessions, it just fell a lot. So the portfolio is not immune to things like that. In fact, we have a slide where we want to share a little bit more detail of how what is this phenomenon and what are the implications, how to avoid the ill effects of those. So on the left side, you see the black line, which is the gold index. And then you see multiple lines, 4-5 index ETFs, which are trying to replicate gold index. And these lines never coincide. At least in this period of heightened volatility, we saw that there was significant tracking error. So index is somewhere, ETF is significantly below it, and then it spiked and significantly above it. So in effect, two things are happening. One, there may be periods when there is persistent tracking error. And the second, this may end up amplifying the volatility in the asset. So ETFs may be more volatile than the asset itself. So what it means for you is, at your end, you have to make sure you do not deploy a large amount of capital instantaneously or in a very short period of time. It's always advisable to spread your investment over a longer period of time, so that your volatility will average out over a longer period of time, and you'll get much stabler price realization. The second is, no matter how strongly and dynamically the portfolio is constructed and how diligent and disciplined you are in capital allocation, you should expect significant portfolio volatility, especially in periods like this, when there is dynamism on multiple dimensions in economy and geopolitics, asset classes, and so on. So be aware of the volatility and control your exposure based on your own risk appetite, and please consult your financial advisor if you need any help in that. From our end, we make decisions using mean variance optimization. So at a periodic frequency, sometimes it's fortnightly, sometimes it's monthly, we, based on rules, determine how much gold allocation the portfolio will have. And this is not a judgment call. This is done using mean variance optimization. So the system measures the ratio of mean of return to variance of return. Of course, we want higher mean return and lower variance of return. So the combination, the scenario that maximizes the ratio of mean to variance is that scenario that determines how much gold we will allocate. And this is how we will continue to determine. So please be aware of the tracking errors and sort of have a disciplined approach to capital addition and determine your own allocation based on your risk appetite. We've received these questions from many people over the last 2-3 months. So what I explained just now, we've actually written FAQs about it. So you can go to SmartWealth.ai/FAQs, and I encourage you to read more in detail, the phenomenon of gold hedging and what it means in terms of rebalancing, what it means in terms of capital allocation for you. So with that, we are at the end of first section of macroeconomic review, and we'll quickly go through the product and market review. The first part is asset classes, and we see three asset classes on the left side. We have equity, gold, and debt. So black line is Nifty 50, and you see it is below 0% line, so it is underwater as of now. And you see that it earlier in the earlier months it was above zero, and then it kind of, when the Iran conflict escalated, it had a significant downward pressure. It found support in April, but it hasn't really risen beyond previous levels. So but at least it seems like it has found support. Debt, which is in blue line, it has grown fairly steadily over a period of time, and it has grown 13% in the last 1 year. And the golden line is gold. So you see it saw a massive rally when there was a period of uncertainty in global markets, uncertainty in equities. But that bull momentum phase has been interrupted. So it found a resistance at the end of January, beginning of February. And from that time, it has entered a phase of consolidation. Also, it seems it'll be interesting to see, how these trends move forward. But as it turns out, it seems like what was going on in the last 1 year or more, that pattern at least has been broken for now. On the right side, we see our Aspire Diversified Stocks portfolio. This is our oldest offering, and we had introduced this in December 2021. So it has seen more than 4 years. In fact, this December it will complete 5 years. And this is available in two different offerings. So one is Aspire Diversified Stocks portfolio, which is a portfolio of 5 stocks, and it can manage up to 10 lakh rupees investment. And Sprint Diversified Stocks portfolio, which is a portfolio of 30 stocks designed to manage up to a maximum of 25 lakh rupees investment. And both of them sort of have similar underlying framework, which we will discuss a little bit later. And what we see, if you see the recent past, from September 2024 onwards, the market is essentially flat. And it is obviously volatile, but largely flat. There's no sign of positive or negative momentum. And during this period of time, the market, our portfolio has done significantly better than market in two terms. One, it has done good job of controlling drawdowns, and second, it has made the portfolio somewhat less volatile for most of the parts. And this is coming from the dynamic gold hedging that we have in our portfolio. Both Aspire and Sprint Diversified Stocks portfolio, they are actually number one and number two quant small cases by 3-year return on smallcase.com. And this is what most of our subscribers use. And while it while it tends to do better than market in terms of volatility, drawdown, and also is a little bit more efficient in capturing upside, is not free of volatility. And you can see this January, when the gold saw volatility and faced resistance, and even we had similar trend sort of reflected in our portfolio as well. So really important for you to be disciplined in terms of applying capital, be disciplined in terms of rebalancing. So that would be our request The second review is of factors. So on the left side, we see two factors and Nifty. So the black line is Nifty. This is the last 1 year of data, and the blue line is alpha, which is a factor, and NSE has an index that replicates this factor, and the golden line is low volatility factor. So the big picture view is all of them are near zero. So no matter which factor you pick, they're all sort of volatile, and they lack trend, any sort of trend as of now or in the recent past. The second is all of them fell pretty dramatically in the first quarter, and they found support. They seem to have found support in April, and currently they are around zero. And there's no real divergence among factors. So all of them are, I mean, both the factors that we track are sort of exhibiting similar behavior. On the right side is our Aspire Diversified Factors portfolio. We launched this in November 24, and pretty much the whole time market is flat. And you can see at the bottom there's a table that shows how our allocation adapted to the trends that we're seeing in the market. Until August of last year, you can see, there were times when low volatility factor was receiving allocation. There was brief period of time when alpha factor was receiving allocation. But for most part, you see two different pictures. Until August, it was the factors were getting allocation, and after that, really factors have lost momentum, and most of the allocation is in gold. Earlier, you can see through dynamic allocation to factors, the gradual advantage was getting accumulated, and August onwards, really there's negligible allocation to factors, mostly gold, and it has helped sort of capture some of the upside that is going on in the gold. And that's how it is done slightly better than the index. Overall, this is slightly different way of managing your portfolio than stocks. And because this does not participate in direct stocks, it only participates via ETFs. So the result tend to be somewhat uncorrelated with the stocks portfolio. And it may be a good opportunity for the users of our Aspire diversified stocks portfolio and Sprint diversified stocks portfolio to add this for diversifying the results of your stocks portfolio. The third one, which is a thematic portfolio, and reviewing the themes. On the left side, we see 1 year view of various themes. Three major observations. So while the broader trend of downturn and finding a support in April is reflected here also, what we see differently is there is divergence among themes, greater divergence among themes. And the themes that have taken significant beating and continue to remain beaten is reality, tourism, Nifty 50, which is a broad index, to some extent even oil and gas. Themes that are showing early indication of some uptick is capital markets, healthcare, defense, and these kind of correlate with the observation we made in the macro economic review. And our portfolio, how it has navigated the situation, is on the right side. More or less, it has sort of tracked the index. And we see the picture again unfolding in two different episodes. So until April, when the market found support, there were downward pressure, and after that, there is some sign of reversal. It will be interesting to see it will persist or not. As of now, our thematic portfolio holds capital market, defense, and healthcare related stocks, which is somewhat reflective of where the momentum exists in the market. And this is reviewed on a monthly basis, and portfolio allocations are made accordingly. And we expect this to do well uh, if the market positive momentum in the market persists. So with that, we are through with the product review. We received quite a few questions seeking information about how our portfolio works, what is our broader framework. So we'll spend a couple of minutes and share those insights for everyone's benefit, because these seem to be, people seem to be interested in knowing more details about these. So our philosophy is diversified momentum investing to help people achieve accelerated financial independence. So diversified momentum investing is our framework that consists of 5 layers of diversification to serve 4 investor personas using 3 strategic portfolios. So our goal is to try as much diversification, bake in as much diversification as possible. And we aim to diversify across sectors, market caps, themes, asset classes, and strategies. And we serve all the 4 stages of an investor's journey. So we see the investor's journey in these 4 parts. Aspire is the first part, when somebody is starting out as an investor and they want multiple choices. They want to experience different products and see which of them really suits their requirement or not. So they start small, but they want more choices. The second stage is sprint, when you realize that, okay, I now want to maximize my or increase my focus, spend in more time to learn, and perhaps narrow down my choices and accelerate. So that's the second stage, sprint. And the third stage is mid-career, where your portfolio has become fragmented. You have a lot of work in office, a lot of responsibility at home, and you want to free up time by consolidating. So that's the third stage, endurance. The last stage is triumph, where your portfolio is large enough for the portfolio to generate yield, which can take care of your living expenses. So in other words, you've reached financial independence, but you want to continue your portfolio to perform at a higher rate of return than the market and smartly diversify. So we help using these 3 portfolio. We have portfolio of stocks, we have portfolio of assets, and we have portfolio of factors. And then combination of these. So we have 2-in-1 combinations and 3-in-1 combinations. So this is what we do to help. And diversified stocks portfolio is our flagship offering. This is what we started with. And most of our investors are using one of these 2 products, which is Aspire Diversified Stocks Portfolio, which is a 5 stocks portfolio designed to manage up to a maximum of 10 lakh rupees investment, or Sprint Diversified Stocks Portfolio, which is a portfolio of 30 stocks designed to manage up to a maximum of 25 lakh rupees investment. And both of these are reviewed weekly, typically on a Thursday. And large allocation decisions are made in the last week of month. So first week of month are suitable for you to schedule your SIPs, etc. And the top half of this slide shows how this portfolio adapts to the market regime. So when the market is bullish, this portfolio can allocate all 100% to stocks. And when it becomes less bullish and we don't find enough number of stocks meeting our criteria, it can allocate some amount to sector ETFs, which is a way to continue to participate in equities when direct stocks may not qualify. When it becomes less bullish, the portfolio has the ability to move out of stocks and allocate to debt. And it becomes bearish, it can bring in some amount of gold, whatever is the optimum amount. And when it is in a crisis mode, it can allocate all of it to gold. So by way of dynamically adopting to various regimes, it has the ability to manage allocation across these 4 layers. So sectors, ETFs, so stocks, sector ETFs, debt ETF, and gold. That is how it maneuvers different regimes effectively, manages risk, manages upside capture, drawdown reduction, and those kind of things. So that was a quick overview. And moving to the last section, which is resources. This is to really help you make the most out of SmartWealth.ai. So most of our resources are on our website. On our website, you will see testimonials of successful investors of SmartWealth.ai, and you can see what has really helped them to be successful. They have been very kind to generously share their insights. We also write blogs of 2-3 types. So we talk about market analysis. We have educational tracks. I'll share a little bit more about educational track in the next few slides. We've put in a lot of effort to build this body of knowledge under frequently asked questions. And this FAQ section is divided into 4 parts. Questions related to the strategies, so investment strategies, questions related to capital deployment, and then question related to execution of rebalances, and question related to platform. So in strategy questions, you can, it'll answer questions like which will help you identify which is the right strategy for you, how to use these strategies, why, what are the rules, why they behave in certain way. Deployment will help you with your questions related to what is it you can do to, optimize your capital allocation and what may be the capital allocation cycle. Execution will help you with practices that you can take to make your rebalances more efficient. What can you do to reduce price slippages in execution? What can you do to reduce your transaction costs? Those kind of things. And platform related, it will have questions related to subscriptions and your broker related questions or small case related questions. On the top right, you see there's on our website, you will see this panel. So once you have a question, you want some information, what may be the most efficient way for you to really seek that information? We encourage you to start with FAQ. It's very likely that the question you have, somebody else might have also had it, and you can get the information very quickly without really having to write an email or reach out to us. And we've also made product videos. So every product of ours has a video to explain how that product works. So we encourage you to really go through those, and it'll make you aware of how the portfolio works and what to expect in different market regimes. If the information you want does not exist on our website or videos, etc., please feel free to write to us at connect@smartwealth.ai. We usually answer all our emails very promptly in one business day. On our website, you will also see a Google Meet scheduler. So if you have questions where you think asking and conversing directly with us will help, you can schedule those meetings. Our calendars are public, and every email that goes out from our account has these links in the footer. So you can think of this as a bookmark of sorts. Here also, there are those links related to FAQs, related to product videos, and how to reach out to us on Google Meet, etc. So those are the resources, and they can really make your journey with us very seamless, and would encourage you to make use of it. About a quarter ago, we started this initiative of private manager update. So all our subscribers can access such an update on the small case app. The third tab, when you click on any product, the third tab is the update tab. And once a month, we do a thorough review of allocations across all the portfolios. So this can give you a glimpse of how market is doing, how our strategies are trying to navigate, which of these are in bullish regime, which of them are bearish regime, and it can help you make your decisions a little bit more smartly. And it can also help you be aware of what's going on and what to expect. And like I said, about a quarter ago, we also started educational track. So we talk about two things here. One is financial awareness, and the second is quant investing. So on these two broad themes, we write content, and we've done, I think, 2-3 of these. If you have any request for us or any suggestion, please feel free to write to us, and we'll try to include it in our future blogs. So that completes the resources section, and we are now into the last section, which is Q&A. So Sumit, if there are any questions, maybe you can collect those, and we can answer those one by one. While you collect those, there are two questions that we receive over email, and might be relevant for everyone. So I can begin answering them. So the first question very often asked is, it's about the geopolitics that is going on, and what is the implication of that? So is really the worst over, and what to expect? So our observation is that the peak crude oil price, the peak that was reached about $110 or so, really that peak is over. So it seems like the worst is over, but we've still not reached the long-term trajectory. So we are in a state of elevated energy costs. While the worst is over, the status quo is not the same as where we were. So there will be prolonged period, or so it seems, of high energy cost, and obviously GDP is extremely sensitive to energy cost. So we may have challenges on economy as time progresses, but it's yet to be seen. But as it's the first observation is that the worst is over. The second thing is, a related question that we hear often is, therefore, which are the sectors to watch out, and what's the outlook on sectors? So when a crisis of this magnitude and this sort of nature unfolds, the two sectors that provide defense are pharma and consumption. So both pharma and consumption tend to be relatively stable, tend to be sort of safe haven sectors when crisis of this magnitude emerges. So those, I would say, are the defensive sectors, specifically because the present crisis is not only monetary crisis, it's also geopolitical crisis. So defense continues to be a strong theme. Defense emerged as a front runner about a year or two ago. And our view is that defense will remain a front running theme for at least a decade, because geopolitics is not going to solve in a hurry. The third implication is that a lot of this is about energy. So there will be selective opportunities in PSU, which we have to sort of wait and continuously track. But this may require nimble approach. So really threefold answer. One, stability is likely to come from pharma consumption kind of sectors. Second, a persistent growth trend might be defense. And in between, selective opportunities might be there in PSU sectors, which is energy related PSU sectors. So those are the two questions we hear often, and happy to share those insights. So with that, I'm passing to you, Sumit. If there are any questions, we can answer those now.
Yes, thanks, Pankaj. So there are some questions in the chat, but before we go to that, let me quickly ask you a couple of questions we got through email. So one question that we got through email was that like in every portfolio we mention that it contains a certain number of stocks, but sometimes the actual stocks in the portfolio are slightly lesser than what is mentioned in the product description. So why is that? So for example, there's a question from a Sprint DSP subscriber who says that right now there are 4 stocks, but the product description says 30. So why is
Yeah,
that, and is that not a concentration risk?
yeah,
So can you just shed some light
yeah.
on this?
Right. So it's a very valid observation, and the answer is here. So it's a diversified stocks portfolio, but it has dynamic ability to bring in debt and gold, or even sector ETF. And we have very strict checks on what kind of stocks will qualify. So we have checks on liquidity, we have checks on volatility and regime and momentum. So only when these criteria are fulfilled, then we include those stocks or consider that in the universe. So if we have less than the number of stocks that the portfolio is designed to handle, that basically means the universe does not have enough stocks that qualify. And if that doesn't happen, it will activate plan B, C, and D, which is use sector debt or gold ETF. So in while it may seem like it is increasing the risk, but what it is essentially doing is it is decreasing the risk from equities. And over a long period of time, these tend to reduce the risk and reduce the risk of drawdown.
Okay. The next one that we have through email was a question about Aspire DSP. So the question is, we have a maximum investment limit of 10 lakhs. So why do we
Yeah.
have this limit in the first place? And
Yeah.
what is suggested when a subscriber reaches this limit?
Yeah. So, why there is a limit? Because the market has a finite liquidity. So we consider stocks which trade on an average more than 5 to 10 crore rupees per day. And there are only about 1,000 odd stocks that qualify. So if you build a portfolio of 5 stocks, it'll have certain total liquidity that market offers. Now, we don't want to be in a position where collectively our clients, subscribers, investors deploy capital more than what the market offers, the liquidity that is offered. That is why we recommend this limit. Every portfolio is designed for a certain limit, and this limit in principle links to the liquidity in the underlying universe. That is how it is designed. So that's the reason for recommended limit. Now, what can you do? We've designed these 4 portfolios or 4 stages of investor journey, which is Aspire, Sprint, Endurance, and Triumph. So by design, Aspire portfolios are designed to handle a maximum of 10 lakhs. Sprint can handle up to a maximum of 25 lakhs. Endurance can handle a maximum of 50 lakhs. And Triumph is designed to handle a maximum of 75 lakhs. So what you could do is you could consider, once you have reached that 10 lakh on an Aspire, you essentially have 2 options. In principle, 2 approaches. One is, if you want to continue on a similar path, if you're an Aspire diversified stocks portfolio user, you want to continue a similar profile on a longer capital, you can consider Sprint diversified stocks portfolio edition. If you want to enhance diversification significantly, then you could consider something like Aspire diversified factors. So by way of that, when you add a different strategy family, it will tend to neutralize some of the volatility and risk while giving you additional capital runway. But if you want similar profile to continue, you can add Sprint, which is a 30 stocks portfolio. Obviously, more number of stocks means greater liquidity, and that is how you could manage larger capital.
Okay. So I'll take some of the questions that are there in the chat now. So if you have questions, please feel free to type it in the chat. So let me take some questions from there now. There's one question from Rakib, who's asking, given the current macroeconomic situation, like valuation levels, FII flows, earnings growth, and global uncertainties, what is your outlook for the rest of 2026?
Right. So, see, this can be seen in 2 parts. So, one is what's the economic trajectory we are on, our own GDP and corporate earnings, so on. The second is, of course, geopolitics. So, let's start with the easier one first. So, geopolitics manifests in creating broad asset class trends across the world. So, which is largely about, in our terms, it is largely about equity versus non-equity assets. So we have to be nimble to sort of dynamically adapt to the unfolding trends, and uh, our portfolios inherently have the structure of diversifying across asset classes. So we can dynamically bring in debt and gold. Dynamically meaning through our constant revision process, which is monthly review revision process. So it can adapt to those trends fairly reasonably. The second is, what's going on in economy, FIIs, etc. So FIIs is a different story. FIIs have very different dynamics than the dynamics, for a local investor or a domestic investor. So the overseas investors are more susceptible to currency risk than we are. So when we earn in rupee, invest in rupee, and get returns in rupee, we are not so much concerned about exchange rate fluctuations or even rupee depreciation for that matter. Whereas FIIs are more susceptible to currency depreciation risk. So I would say that that FII issue is a non-issue for most of the domestic investors. And the early, whatever the fundamental numbers we see, the economy is in good shape and it should continue to do well. And as an investor, I would say, what our algorithm does is it, in a disciplined, rule-based manner, it identifies the the stocks that have strength and also diversify as needed. So as an investor, you should really rebalance promptly, look for the advice promptly, and follow the good sort of rebalancing practices.
Okay. So the next question we have is from Vinod, who's asking, how do we access educational tracks? Maybe I can answer it quickly. Like we have been doing it for 1 quarter now, and in every month we write 2 blogs, one related to financial awareness and one related to quant investing. So the previous blogs that we have published are available on our website. So you can go to smartwell.ai/blogs, and you can access the blogs that we have written in the past. And in future, like whenever we write a blog, we send a newsletter. So if you want to subscribe to that newsletter, you can go to our website and you can enter your email address there. So next time whenever you publish a blog, you'll get a notification. So with that, Pankaj, there are no more questions in the chat now.
Yeah.
So we can close this webinar. Thank you very much, everyone, for your participation. We really appreciate your time. Pankaj, any closing remarks from your side?
Well, thank you again for joining on a Sunday. Really appreciate, and I hope you found this webinar useful. We value your feedback. If you have any suggestions on what we should include in the next webinar, please email those to us at connect@smartwell.ai. We'll be happy to include. And if there are any questions that you might have after seeing this webinar which are unanswered, please write those questions to us. We'll be happy to answer. Thank you again for joining. Have a good Sunday.
Thank you, everyone. And there is one comment from Rakib asking what are the good rebalancing practices. So, Rakib, you can see this in the FAQ section of our website. In FAQs, there is one section called execution. So there you can see what are the good practices or best practices related to rebalance. And if you have any further questions, please feel free to reach out to us with all the channels mentioned on the website and also mentioned in Pankaj's presentation. So thank you very much, everyone, again, and see you next time. Have a great Sunday. Bye bye.
Thank you. Bye bye.